Egie, thank you for taking the time out to join us today.
Good afternoon, Esther.
I think a good place to start would be the performance of the market performance today. That's the fixed income market. We're resuming after that tumultuous week that we had last week, and now the markets are open for business today. But let's start with today's overall performance at the fixed income market.
Well, there was actually no closure last week. I mean, the curfew was really largely a Lagos problem, and the market was fully trading on all those days. But what we've seen is pretty much virtually, I'll say, record low interest rates as of last week due to some activities in the prior week, primarily the DMO bond auction, which eventually sold only 45 billion or 40 billion in bonds, and had offered only 30 billion. And there's still no calendar for the quarter. So effectively, the federal government has reduced dramatically the supply of new issues in the primary bond market. And so that market has repriced downwards substantially. So we're now in record low territories in terms of both long and short-term interest rates. Short-term interest rates, you can't find a one-year treasury bill to buy at 1% right now. You're looking at a 30-year bond below 7%, which is very extreme. So yeah, record low in terms of interest rates for the fixed income market for federal government securities.
Now, speaking about still on interest rates, I'm happy that you mentioned that. If rates are decade lows now, why don't we see a lot more corporates and states coming to the market, particularly the first-time issuers?
Well, again, it's a question I myself ask, since that's the primary thing I do for a living. One challenge is it's a lot of work. That's number one. And so not everybody is prepared to go through that amount of work. Maybe some people underestimate the savings they will get coming into the market. And normally there is a lag between when you start your transaction and when you're in the market. So people coming into the market now have been working on these transactions for several months. Having said that, you tend to see a lot of transactions in the fourth quarter, partly because of accounting cycle of companies. By the time they get their audit out, their accounts out of the way, by the end of first quarter, they figure out what they want to do, another quarter gone. So by the time they really get going, they're almost in Q3. So there's quite a number of transactions coming to the market now that have been on the drawing board for the past 1 or 2 quarters. And so we'll probably see a record level of primary issuances from corporates in Q4. In terms of state governments, there are a few technical issues why you really don't see many state governments come to the market. They're more regulatory related constraints rather than the state governments not wanting to take advantage of low rates. But I think there's also the risk for a number of expected issuers. Some companies simply have nowhere to put the capital. Right now, a number of companies are not expanding because the economy is actually in a recession, technically. And so their CapEx plans are on hold until things are a bit clearer. So those people you would expect to come and borrow are not borrowing. But for sure, Q4 is going to be a record quarter for corporate debt issuance.
But still on the corporate debt, let me just quickly bring your attention to First Bank of Nigeria. Now, it's on Tuesday last week, it did issue a $350 million 5-year Eurobond at 8.875 yield. Now, why do they have to pay so much in USD dollars when they can issue it in Naira, perhaps at even a lower rate?
So you now have this very almost unprecedented situation in Nigeria where Naira borrowing costs for the exact same issuer, the same terms, and the same tenor are actually lower in Naira. So I think it's safe to assume that if First Bank was to do that exact transaction, 5 years senior in Naira, I don't see them paying anywhere close to 8.875. And so, of course, this problem is also applicable to the Nigerian government, who had shifted to foreign borrowing in the past and even refinanced treasury bills with very expensive long-term dollar debt, and now has a situation where they can issue 1-year paper at 2%, whereas they're paying 7-8% on dollars. So it's a market-wide problem because of CBN activity. It is cheaper to borrow now in Naira than dollars. However, the fact that you have 390 Naira doesn't mean you have $1. You could queue in the I&E window for months without getting your dollars. So for a bank like First Bank, if they actually physically need dollars, not just money, they need US dollars, they went down a route that is probably one of the best options they have. So I'll assume that money is always going to be kept in dollars to finance dollar obligations and dollar clients they have. If you bring it to the Nigerian government, it becomes a tricky one because Naira borrowing costs are so low, but borrowing Naira doesn't solve your dollar requirement problem.
Okay, I know that, I mean, you also did put out in a note, I mean, sharing your thoughts with CNBC earlier that you're wondering why the FGN is reluctant to tap the Eurobond market after being very enthusiastic issuers in the past few years. And I know that the Vice President has said that there won't be any, the government will not be going to the Eurobond market this year. Could you just provide us some more perspective?
Well, I think he said this year. And so that, I think the year is almost over. The question is next year. The borrowing plans for the federal government next year, I think a bit over 2 trillion foreign debt that is not DFI. The question is, where will you get that money from? I think the challenge is that we're now in a total reversal of the medium-term borrowing plans that particularly DMO put out in the past of foreign borrowing over local and a whole bunch of other things. You have a situation where if you're at the Ministry of Finance and you're being criticized for your debt service ratio, you need to just bring your borrowing costs down through any means. Even if it means borrowing 1 year money at 1% or 2%, it will bring your debt service down. And so that's their concern now. Clearly, if we use the First Bank example, the Eurobond market is not going to save them debt service because they'll be paying maybe between 7 and 9%. So if they borrow in Naira, it will cost a lot less. However, you have the reserves and balance of payment and other CBN-related problems around physical dollars, which cannot be achieved with Naira borrowing. And so I guess the central bank and Ministry of Finance have to come to some kind of arrangement where the ministry does borrow money in dollars through the Eurobond market to help the reserve position. But again, it'll be costing them so much that their primary option will be to take the cheapest money available, which right now happens to be Naira. So I think eventually Absolutely. They will have to do something in that market because the reserves need that infusion of dollars. And apart from a Eurobond issue, I'm not clear where any large amount of dollars is coming from next year, apart from the DFIs that you mentioned.